You should see a prompt on your end of the screen. Okay, great.
Okay. All right. So I switched to my computer mic. So I hope that you can hear me loud and clear, because I'm actually using this very special mic, this expensive mic, but it doesn't work today. I don't know why. Okay, now so I will speak loud so that you can hear me loud. So I'm going to catch up on the last time. All right, so today I'll be talking about few things. Number one would be the evolutions of futures trading, meaning that the basic of futures trading, so that you know that whether you are trading the SiMSCI or you are trading any other type of futures, then that would be a very important and informative background, okay, of futures trading. Then specifically, we're going to talk about trading into the SiMSCI, okay. Next, the third part will be on the using the SiMSCI as a hedge. So if you have, for example, a lot of stocks that's made up of especially Singapore banks, DBS, UOB, OCBC, then SiMSCI will be very good in case that the market is going down. Then you can use that as a hedge. Okay. Otherwise, you can use SiMSCI as a form of profit generating tool for your own trade. I'll be also talking about the common methods of swing trading. So what are the swing trading methods? All right, but more important, during the later part, I'll be showing the live trades that I did, because I realized that you need to see live to know how things work, okay? So I'm going to show to you the live trades, but it's being recorded, okay? Because sometimes we might not have that trades ongoing, okay? So I will go through, for example, things such as why these trades are being put in, how to manage the trade along the way, especially, for example, if you have a losing trade or you have a winning trade, how to manage these trades along the way, all right? Every time when you attend my webinar, for example, these live trades will be different, because it show and it capture the trade that I did or I've done, in the period when I'm preparing the material. Okay. Now, a bit of introduction about myself. So I've been training for quite some time already. I look at some of the names. I've seen you. You have attended my lesson. I talked to you before. But SiMSCI, I started with SiMSCI in my very early years. Okay, I started with SiMSCI. I started with the Hong Kong index. Okay, the mother and the son, right? Because the son or the daughter is cheaper. So I started with all these instruments and slowly progressed into equities and forex and commodities. In fact, that I trade almost everything. All right. So SiMSCI is exciting this week, last week. The forex is a little bit not. So, basically anything that moves, I will move to trade that. Okay. All right. Now, let's talk about the evolutions of futures trading. All right. First, if you look at what is a futures contract, so for example, a futures contract is a contract that a buyer and a seller of a product, remember there's always a product involved, okay, at an agreed price. That means that the buyer and the seller agree to transact this product at a fixed price they agree on, but at a future date, not now but later. Okay, so what will be the specific that they agree on this particular contract? Number one, they agree that the buyer and the seller, they agree, for example, the buyer will buy, let's say, 1,000 kg of raw material. What are the raw material that can be transacted? For example, we assume that the buyer is making orange juice, okay, and then the seller is a farmer who is growing oranges, okay, farming oranges. All right, so the buyer wanted to buy oranges from the farmer to make orange juice. Okay, so for example, the buyer right now at this moment agree to buy 1,000 kg of oranges, okay, from the seller. But what's being agreed? For example, the buyer agreed to buy per kg at $1. So that's the price they agree, and they agree on the quantity, all right, which is 1,000 kg. At the same time, once being agreed, then the seller will agree to sell, to grow and to sell, all right, and to supply 1,000 kg of oranges. Okay. However, the deal has been made on the 29th of October earlier, but they will only transact, meaning that the seller will only deliver the oranges, the buyer will only buy the oranges at a later date, at a future date, which is not now, but at a later date. All right. So For example, the transaction will take place around 28th of December. That's why it's a future contract, not now, but later. Okay, so why does the buyer wanted to agree at the price now and the quantity now? Because probably the buyer wanted to fix that amount, but more important, the buyer wanted to hedge their risks. Okay, probably because the buyer foresee that the price of oranges might go up in the future. Therefore, the buyer wanted to lock that price and lock that quantity so that they can hedge their risk in case that in the future the price of oranges is to go up or they can't get the quantity that they want. Okay, the good thing is that at the particular date, all right, they will have a physical delivery and the buyer will get what they want, which will be the oranges. Now then, why does the seller wanted to agree to sell the 1000 kg of oranges right now at the current price? Okay, the seller also wanted to hedge their risks, meaning that probably the seller might be have a special information to know that there could be an oversupply of raw material in the future. For example, 1 year ago, many farmers farmed many trees, and 1 year later, oranges were grown already. Thus, all right, 2 months later, there could be an oversupply and prices might move down. So the seller would want to agree on the price right now in fear that in the future, the price might move down. Okay, of course, and nobody knows what's going to happen in the future, all right? But they decided that it will be best in their interest to agree at that price, which is $1 per kg, and to transact 1000 kg, but to deliver at a future date. All right, now coming back to right now, so that's what happened in the past. Coming back to right now, then traders turn this contract into something tradable, because from now till later, which will be on the 20th of December, there's still time, right? So what they can do is that they can trade on this futures product. They can trade on this contract. So in between, when it goes up and go down, for example, from $1, maybe that right now there's a storm and the oranges had a decrease in the supply, then perhaps that from now to 20th of December, price of the oranges actually move up to $2. Okay, so you can transact right now, or perhaps that maybe the seller wanted to sell that particular contract to another to another buyer at a higher price, and after that, they can make some money here and there. So these are the futures that can be traded, and in the modern days, we have turned this tradable contract into something where we do not need to have physical delivery, meaning that we can go for cash settlement. All right, so the good news is that you don't need to grow oranges, you don't need to have pigs, you don't need to have livestock. You can just do what we call a cash settlement without physical delivery. All right, so let's take a look at what are the futures contract that can be traded. One, the left hand side will be the commodity contract. All right, so for example, you can trade the metals, which is gold, silver. That's very common. Gold had a huge up and has been very stable right now, so you can trade the gold, or you can trade the metals, the base metals, or you can trade the agricultural products, the soy, the corn, the sugar, or you can trade energy products, right, like the crude oil, natural gas, or you can trade even livestock. All right, now in the other group of futures product, that would be the indexes products and the interest rate and the currency futures. Okay, so for example, under the indexes in Singapore, you can trade the SiMSCI. Okay, or you can even trade a single stock futures. So for example, you don't like to trade the stocks, okay, you can trade the futures of the individual stocks, or you can trade the currency futures or the interest rate futures, treasuries futures. So basically, I will really sum up that as long as a product is in demand and the exchange launch it, you can really trade that. All right, now what are the basic things that you need to know about trading futures? Number one, all right, do know that futures, they are exchange traded, and this is a very important part of why it is good to consider futures trading. Okay, especially that I do get quite a lot of questions on why must I consider futures trading over a contract for different CFDs. Okay, just to let you know, for example, if a futures is exchange traded, then the exchange also guarantees that the contract will be honored. eliminating counterparty risk. And the counterparty risk is very important because every exchange traded futures is centrally cleared. All right. Now this means that when a futures product is bought or sold, then the exchange becomes the buyer to every seller, the seller to every buyer. So these would reduce what we call credit risk, especially with default of a single buyer or seller. All right, so it means that you are actually like doing transacting stocks. You are dealing with the exchange. That gives you a certain level of assurance here. Okay, now the futures contract, every specifications, they are standardized. Okay, whether you are buying a lot of this particular contract or just buying one contract, that specification would be standardized, such as, for example, the weight, the volume, or the amount. All right, especially when you're doing the financial contract. Okay, now every contract has a contract month or a delivery month. Thus, every contract will have a date, right, in which they expire. Okay, so you can see, for example, the right hand side here at this place. All right, there will be this where you can see the contract months. Let me just scroll up. Okay, wait, it doesn't want to go up. Okay, here you go. Now, so there will be a date, right? That will be a expiry date. This expiry date will be fixed as well. So every month, the exchange will let you know when it's going to expire. So you know that you can jump on to the next month to trade the next month's contract, right? So when it expires, there'll be two things, right? Remember I talked about that you can do a physical delivery, but when you are trading SiMSCI, for example, it will be a cash delivery. So your profit and loss will all be settled in cash. And if you want to hold the contract until expiry, all right, you don't need to deliver that contract. It will be, the settlement will be all in cash. Okay. Now let's take a look at the mechanics of trading the futures. Number one, you can do on either direction, meaning that if you decided that in the future it's going to be positive, so you can go long. Long is basically the term for buy. Okay, or you are negative, you think that the contract will decrease, then you will go short. Short is the term to say we are selling. Okay, so instead of saying that I want to buy, we would say that I want to long the SiMSCI contract, the December contract or the November contract. Or you want to say I want to short, then instead of saying sell, I want to short the December contract, for example. Okay, now when you want to trade, all right, there will be always the left hand side and the right hand side price. Okay, meaning that you're going to see the bid price and the ask price. Just remember that if you like to long or you like to buy, you will always be buying at the ask price, which means that you will always be buying at the higher price. Okay, we are always worse off. Therefore, when we buy, we always buy at the higher price. Thus, you will make a profit if in the future the price is to be higher than the transacted price that you bought in, okay, which is the ask price. All right, now if you want to go short, meaning that you are bearish, then you will be transacting at the bid price. Okay, you have to press the bid button here to transact, to go short. Just remember, every time when we transact, we are worse off. Therefore, we will click the bid to sell. Okay, now you will make money or profit only if in the future the price is lower than your transacted price. Okay, now as I explained that every contract would have a specifications. So different contract have different specs. So for example, for the SiMSCI, all right, the contract size would be $100, which is the multiplier times the index. Okay, so for example, if you take a look at the current bid and ask, okay, so if the ask price is at $295 and you like to buy, which is like to go long, okay, so the contract size would be $295 times 100. And because this is a SiMSCI is transacted in Singapore, so the base currency would be in Sing dollar. So for example, if you are trading, let's say the oil, that will be in USD, or if you are trading the Hang Seng Index, that will be denominated in Hong Kong dollar. All right, so for the SiMSCI, each tick all right, each movement, okay, each change in price will be 0.05. Okay, we call that each tick. Okay, so if you were to trade one contract, okay, each tick would be $5. This means that 0.05 will be $5. Thus, 1 point movement will be $100. For example, if price right now is 295, it moved to 296, that's 1 point. That would be a profit of $100 if you trade long for one contract. Okay, all right. Now when you in about this year in March, okay, I think it was in March, you heard over the news that Dow Jones had the limit up, the limit down, etc. Right? So that's because of the futures market. So the futures market will have what we call a price range. All right, so that's being determined and calculated by the exchange. So when you have this limit up or limit down, meaning that there will be a range that is permitted to let the futures trade in each trading session. All right, so price when it moves extremely up a lot, okay, so it will hit the limit up, okay, or when it moves extremely down by a lot, all right, out of the range, it will hit a limit down. So different contracts will have different limit up, limit down rules. Okay, just to let you know, that is part of the protection also. Okay, now because the futures contract is a leveraged product, this means that you can use a fraction of the cost to trade a large contract, and that makes it attractive. Okay, it means that in order to trade the huge contract, you don't need to come up with the full amount. You just have to come up with what we call a collateral, and this collateral acts like a deposit with the counterparty. Okay, the counterparty will be, for example, the exchange, right? But then the broker will collect this collateral, which is like deposit on your behalf. Okay, so when we transact a particular contract, example the SiMSCI, we will look at three things. Okay, what would be the initial margin? Okay, meaning that the initial margin, all right, these will be the amount of collateral, which is the initial deposit that is required for a new position. Okay, then we will look at the maintenance margin, or some broker will call that a overnight margin. Okay, maintenance or overnight margin. All right, so this means that this will be the minimum amount of deposit that is required to keep this position before you result in a margin call. Okay, what's a margin call? Means that, for example, if your particular trade enters into a loss, all right, and it goes below the minimum deposit, that means in your account, right, it doesn't have enough money, it goes below the maintenance margin, the minimum amount of deposit required, then you might get a call from the broker to ask you to top up the margin. Okay, some people are scared of margin call and say, hey, look, I better don't consider futures trading because I might get a margin call. So usually the brokers are quite kind. They call you, you top up the margin, then they won't force sell your position. They will just keep your position there, all right? And the margins are reviewed on a regular basis, and that keeps your account, all right, your money management in a very healthy basis. Okay, now a lot of people, a lot of professionals actually use the futures for hedging. Okay, hedging means that they might have an existing portfolio, right? So instead of selling away the existing portfolio, they use it to do the opposite direction, to hedge into their existing portfolio. So I will talk about more later on how to do the hedging. Okay, now as I mentioned, in terms of the hedging, it is very important to know the contract value. Okay, meaning that you want to hedge a particular instrument, you need to know what's the contract value of this instrument here. So for example, as I mentioned just now, the SiMSCI has a multiplier of 100. 100 times the current value will gives you the contract notional value, and that will be very important for you to do your hedging later. All right, this is a new term that's been out, I think because of the 2007-2008 financial crisis, all right, which is called mark to market. This means that there will be a final daily settlement price for futures, and that's the same for everyone. Okay, this is set by the exchange. So once the mark to market value, the number that value has been established, then your broker will calculate your daily profit and loss, and they would no losses will be carried forward, they will have to adjust and accordingly. So therefore, once they make the adjustment, and if your net equity, meaning that calculate all your positions plus the amount of margin that you pledge with them, then if that falls below what we call the maintenance margin, then the brokers will have to contact you. Okay, so the good thing about mark to market means that it keeps track for you every day on your position, so that you don't overblow your account. Okay, all right. Now, as I mentioned, for futures trading, there will be what we call the expiration, meaning that it will expire near towards the end of every month. For example, for SiMSCI. Okay, so first you're gonna have the last trading day for SiMSCI for that contract, and the expiry will be the day after the last trading day. Okay, some people are afraid of this expiry. Why is that so? Because they say, hey, look, sometimes that when something expires, it makes it difficult for me because I can't keep it forever. Don't worry. All right, as I explained, that when your particular contract is about to expire, you can do three things. Okay, number one, you can offset your position. What's called offset? So for example, when it's near to expiry day or near to expiry, all right, you start to see that less and less volume being traded in this particular contract. Okay, then what happened? You can offset the position. What is offset? Means that, for example, if you are previously long, all right, then you can sell, and that's called offset, right? And you can sell already, and you can buy the next month. When you offset your current position and you establish a new position in the next contract month, we call this a rollover. Okay, so sometimes your broker can ask you, hey, look, you want to roll over your contract? All right, so what do they mean? That means that they can offset the position in the current month and they open a new position in the next contract month. Okay, now the next method, if for example, if your particular contract enters into expiry, meaning that the contract has expired and you forgot all about it, all right, then don't worry. When the contract expires, all right, you will go into settlement. So your broker will calculate, for example, at the expiry date, all right, what is the final settlement price, and then they will settle for you. So either you will be in profit or either you'll be in loss. Okay, so everything will be in cash settlement. Okay, so not to worry about expiration, because then it's quite a seamless process already. All right. Okay, now let's talk about volume just now, right? I explained that when it comes nearer to the expiry, then you start to see that the volume of the contract dropping. Okay, so in the futures contract, there's two things. One would be the volume, another one would be what we call the open interest. So the volume and open interest are very different. All right, so for example, volume will let you know that if there is a contraction in the current month volume, it means that people are starting to trade the next month already, so you can start to shift over. All right, at the same time, when it's like let's say for SiMSCI, when it's during the cash market where STI cash is trading, you start to see there will be more active trading. Okay, because the SiMSCI trades nearly a whole day. Okay, so even right now it is trading at this moment. All right, so therefore you start to see more volume during the period where the cash market is trading. Okay, but that doesn't mean that you can't trade the SiMSCI even right now. You can do that. Okay, so that's the good part. If you find that overnight has some important events to happen, and then you can already make an action right now than to wait for tomorrow the cash market to open. Okay, now let's talk about open interest. All right, so what's open interest? Open interest will be the number of contracts held by market participants at the end of the trading day, meaning that at the end of the trading day, what's the total contract being held by the market participants. Okay, so how do you calculate that open interest? So for example, A bought 5 contracts, okay, B bought 10 contracts. All right, so in total, because they bought, right, that seems to be, that's 5 plus 10, that's 15 contracts. But C sold 10 contracts. Does it mean that you take 15 minus 10? No. Okay, because open interest will calculate what's the total contracts that's being opened. So right now the open interest would be 5 plus 10 plus 10, so that's 25 contracts. Okay, now open interest show us what we need, which is the market liquidity. So we don't care about direction, whether they're long or short. Okay, we care about whether how many people, how many contracts are being opened. So for example, if there's a large open interest, it shows that the market is very liquid. All right, it means that a lot of money are being flowing, it's flowing into the futures market. All right, so if there should be any movement, it will be a movement that's being supported by interest. Okay, supported by actual money coming in to buy into this particular futures contract. Okay, now when the OI, which is the open interest, decline, it means that money is starting to move out of the market. So why is money starting to move out of the market? Perhaps that then the trend is slowing down, or perhaps that then a particular very important point are being reached. So if you can use the open interest and gauge, for example, the strength of the trend, you are able to know, for example, whether the trend is strong or whether the trend is losing strength. Okay, so open interest and volume, they are very different in the futures market. Okay, all right, now let's talk about specific to trading SiMSCI contract. Okay, SiMSCI, the MSCI Singapore Index, short form SiMSCI. Okay, now what's a SiMSCI? The product code is SGP. So for example, you go to your broker and you see that, hey, look, that's SGP, so that's trading the SiMSCI. All right, so the SiMSCI has a very high correlation to the STI Index. That's about 98% according to SGX. And the SiMSCI is made up of, at this moment, 22 stocks as of July 30th. Right now, no, okay, it's being made up of 20 stocks. They're going to reduce that to 19, all right, eventually 19. Okay, if you look at the right-hand side, on the right-hand side, the Capital Mall Trust and the Capital Land Commercial Trust being merged already. So that's being merged as one. That's count for the reduction. So you have almost all the stocks in STI inside the SiMSCI except Suntec. Okay, Suntec is in the STI reserve list, but Suntec is inside SiMSCI. Right now, if you take a look at trading the SiMSCI, then let's talk about the time, 8:30 to 5:20. Now, this means that if you had overnight movement in the US market or the or for example the European market, all right, and you like to do something about it, so you can start with the SiMSCI half an hour before the cash market opens. Okay, so you can do a lot within this half an hour difference. All right, in fact, that if you want to see the real movement, all right, a lot of people rely on the first half an hour to see the real movement for the cash market. Okay, so it trades until 5:20, and after that it starts again T+1 at 5:50 to the next day 5:15 a.m. Okay, so this is good. Good not because we work more, but good because that if anything that happens to the US market overnight, we can use a SiMSCI to react. Okay, so for example, you might be predominantly doing equities, all right, but because of special things happen, you might want to get ready, all right, SiMSCI or rather a futures trading account, so that if anything happens, you can use this chance to start trading or hedging or anything at after the cash market close. Okay, so that's one thing that you might want to consider. Okay, as I explained, you have the contract multiplier 100, so the contract size will be 100 times the future price. Okay, the minimum fluctuation for retail will be 0.05. Okay, so every time when it tick, it will be 0.05. The next one will be also 0.05 difference. Okay, so that will be $5 per tick, all right, per contract, and it means that 1 point in a SiMSCI, for example, 300 to 301 for a contract, that will be $100. All right, the last trading day will be the second last business day of the expiry month. I know that you say, hey, look, I still have to remember, but it's very clear. If you are trading, you know that the volume starts to decline, that volume transacted for the current month starts to decline, and this is a clue for you to move to the next month already. Okay, so that's settlement will be cash settlement. All right, this would be the daily price limit, and then that would be something which is for the big lots, right? Minimum 50 lots, and position limit will be position accountability. That's not really very important, all right, for retailer. Okay. All right, now let's take a look at the SiMSCI weight. Okay, so as of 3rd November, okay, they will change the weighting quite often, and they just increase the DBS weightage. All right, so increase a little bit of OCBC and a little bit of UOB upwards. Okay, so in total, 3 banks were made up about 40+% already in the SiMSCI. Therefore, if you take a look at this right-hand chart here, right? If you like to, for example, instead of buying directly into the banks, okay, and you like to make use of leverage, meaning that to use a little bit of money to buy a huge amount of bank, all right, instead of buying directly into the bank, you can use SiMSCI as a correlated instruments to the bank, because then it's about 40+% already. Okay, so these will be the rest of the weightages for the rest of the components, right, in SiMSCI. Okay, but very much trading into the SiMSCI, the key is to look out for the bank movement, really. Okay. All right, so to sum up how to get started in SiMSCI, number one, I think that you really have to know more about derivative trading. I hope that the introduction in front in the earlier session is sufficient, comprehensive enough to let you know, in fact, that's really the bulk of trading into the SiMSCI contract or into any futures contract. All right. Second, you need to have a brokerage house, which is a clearing house. All right. So even though the contract is transacting with the exchange, you need a clearing house, which is a broker, to help you to clear that. Okay. Of course, that you need to have initial margin, meaning that you need to fund your account first, okay, before you can start to trade into SiMSCI. So the initial margin from SGX would be 2,200 for one contract of SiMSCI. Maintenance margin will be 2,000. So when you start the contract, you need to have 2,200, and along the way it can fluctuate. It can go up, go down, but it cannot go below 2,000 when you do a mark to market. All right, but the broker will usually ask for more, meaning that they want to have a buffer. So some brokers, depending on different brokers that you go to, different brokers will have different margin requirement, but they shouldn't be too far off from what SGX is requiring in terms of the margin. Okay, and of course that you need to have a charting tool. All right, you need to know all the price levels, because very much when you trade with SiMSCI, you are using what we call the lower time frame. Okay, because some people might want to trade a few tick, okay, when they have a huge volume. Some might just say, okay, half a point, I want to exit already, because that's good enough. All right, so you need to have a charting software, you need to have a trading platform. Trading platform charting software would be provided by your broker. Okay, and of course their education and method. All right, okay, now let me just quickly talk about the hedge in your existing portfolio using SiMSCI, in case that you are doing stocks. In fact, that I am actually having a lot of equities. All right, so I'll also use the SiMSCI to help me hedge. Although as I explained, it will be very good if you are holding a lot of banks. That would be a very good hedge using SiMSCI. Okay, so let's take a look at this particular chart here. So that's during the March period, where price has a huge drop. All right, this year March. So imagine that you bought in and you bought in a lot of banks. All right, so price move up and hit to 2008, and you saw that 2008 was very near to a strong resistance. You know that, for example, it's going to drop, or you have a hunch that it has to drop first, for example, but you don't want to give up your stocks. Why don't you want to give up? Because just about a week later or 2 weeks later, you're going to receive dividends. Okay, you've been waiting and want to receive dividends, right? So you don't want to sell, because in case that you sell already, you can't get it back at a very cheap price. So what can you do? Because you don't want to see your portfolio dropping, all right, but yet you know that it is likely going to come down because it hit into a resistance. Then what can you do? You can use SiMSCI as a hedge. Okay, so how can you do that then? So what we do is that we to hedge, right? Because you own the stocks, you are basically long the stocks. To hedge, you have to short the SiMSCI. Okay, that means instead of purely just shorting for profit, you can use the SiMSCI and you short the SiMSCI so that when your stocks move down, all right, because you shorted the SiMSCI, then that drop can be seen as a profit from your SiMSCI contract already. Okay, right now, so you need to know how many contracts to put in for your SiMSCI, right? So this will be the formula here. Okay, the first you need to know the contract value, the notional value. So what's the notional value for SiMSCI futures? All right, it will be always 100, which is the multiplier, times the current value. So for example, the current value of SiMSCI is 315. Okay, so you take 100 times 315, so there will be 31,500 based on the current value of SiMSCI. All right, so assuming that, for example, the current value is 295, then you're going to get one. The value of one contract for SiMSCI would be 29,500. All right. You have a 120,000 SG. That means that Singapore stocks equity exposure, and they are mainly Singapore banks. All right. So then, how many contracts should you short so that you can achieve a good hedge? All right. So calculate the hedge ratio. It will be the value at risk, which will be 120,000, divide by the notional value, which will be your contract size here, right? So it's 120 divided by 29,500. That would be 4.06. Okay, so in order to hedge a 120,000 worth of equity, all right, you need to short 4 contracts. Okay, some questions I have, right? Sometimes that when you have 4.6, then the question would be, should you short 4 contract or should you round up to short 5 contract? Because you can't short 4.5 contract. All right. Okay. Now, what I usually do is that I usually ask back, what's your objective? Okay. If you want to just go purely to hedge and not to overexpose your REITs, okay, so you hedge on the lower side. That means when you have 4.6, you open 4. So you can't achieve a full hedge. All right. But at least that you don't overexpose your REITs. Or if you don't mind to have a bit of a profit, then you open 5, okay, because then your extra, let's say 0.4 will become the extra profit that you're going to have. Okay, so it really depends on your risk profile. All right. Okay, now here I'm going to talk about some of the methods of swing trading. First I will define what's swing trading so that you understand that, and then more important, I will introduce to you some method. They are by no means comprehensive, meaning that if you wanted to explore into trading SiMSCI, then you can consider some of the methods, but later on I will show you how I did that for some of my trades and to have a few of that excitement. Okay, so there are many trading objectives. So some would like to do the hedging, right? Some would like to do speculation, some would like to take position. Speculations really means to trade for profit. Okay, so they will be just purely to buy, sell without any regards to their existing portfolio. Okay, but some might decided to take position, meaning that they say, hey, look, I'm bullish on STI, but I don't want to buy directly into the banks because they're going to be very costly, because I need to come up with a lot of money, right? So instead of that, let me just leverage onto the fact that SiMSCI is a leverage product, and then I take position, but I don't need to come up with a lot of money. Okay, all right. Now, so there are different trading profile. So for example, if you are doing scalping, really that every time you're asking for a few tick, okay, I have a group of friends, every time they are doing huge, okay, and they only ask for a few ticks and then they go. Okay, so once they just do 2-3 times and they do the few ticks and then done, they basically end the day already. So they will usually do that during the first half an hour and they get it, and then that's it, the rest of the day all done. Okay, but they are really huge trader group of traders. All right, or you can do intraday trading, right? Meaning that today you spotted that there's a potential to go long, to buy into SiMSCI. Your aim is not hold any overnight risk. Okay, meaning that you just want to open a position at 8:30 or 9 or any time, and you want to close the position for your trade position, right, at the very same day. Okay, so that's intraday. Or you can do swing. Swing means that you are looking for a low point and then you trade to the high point. It can be few hours, it can be intraday, it can be 2-3 days. Okay, so there is no definite time here, but you are not asking for a little, you're asking for quite a fair bit of movement each time. Okay, and lastly, you can do position trading, meaning that you regard that as maybe your equities, your stocks, right, in replacement for buying actual shares. You don't mind to buy into SiMSCI, right? Okay, so what I have here is a free charting platform. So for example, if you like to explore SiMSCI first and you want to know how they move, etc., so this will be the place where you can get the free charting platform. All right, it's as close as real time, but if you like, then you can get an account with Phillips, right? Phillips futures, and then they also have the charting platform there. They are equally wonderful. All right, so you can go for this address. If you need to, you can ask them for a copy of this handout. All right, now when you are using the the charting platform that I introduced, okay, do bear in mind that it's important to change the time scale to the GMT +8, which is the Singapore time. Otherwise, the time that you see can be a little bit weird. Okay, so I always change that. The problem is that this is a free platform, so every time when you enter this platform, you have to change it. So it's very troublesome. All right, so if you were to just use a broker platform, all right, then you don't need to repeat this every time. Okay, all right, now so let me just introduce to you some of the method. I would go through some of them quickly because I want to go through one specific one that I'm using, and I find that it can be really very useful. Okay, so the first broad category will be what we call a price action trading, meaning that you basically use price. Okay, so things like breakout or range trading, or for example, when you have a key support, all right, and you can put in things like your chart pattern, your candlestick, bullish chart pattern at a support, and then you use it to buy. Okay, so that's one method. Or for example, you can draw your trend lines, your channels, use your moving average, and you can do what we call trend-based trading. So for example, recently SiMSCI and STI has been moving up. So when you use the lower time frame, you realize that okay, it just hit the moving average and then you will just move up. For example, that's a very nice trend-based trading recently. Okay, but it doesn't happen most of the time, all the time. Okay, or you can use geometric, like the use of Fibonacci or the use of harmonic. All right, there's many different ways, and some people use Elliott wave and many different method. Okay, to me, you use something that's comfortable and something that can make you the money. Okay, that's more important. All right, so what I did here is I've drawn in a trend line here, and you realize that in the live trading, I've used a lot of this style. I just find 2 points and I join the trend line, and once price hit the point, and when it closed above or below the opening range, okay, as I explained, a lot of professional traders, what they did is that they look at the opening range, because the opening range determines the mood of the market. So they just look at the opening range, and if price is to move below the first 30 minutes, all right, of the opening range, the first 30 minutes move below, right, then that will set the mood, and then they just go short, for example. Okay, if price is to move above the first 30 minutes of trading, and then they will go long. It can be just as simple as that, and then they are making a lot of money. Okay, so for example, what I did is I drew a trend line here, and I look at the opening range, and if it's below, I just go short. Right? Okay, so after that, once the cash market is closed, all right, then you can head to the T+1, and that's where it moved mostly, mainly tracking the US market. Okay, mainly tracking the US market. Not all the time, mostly. So this is a very nice ranging trade. Okay, on a 15 minutes, buy low, sell high. Okay, buy low, sell high, for example. All right. Now this is what I call a moving average here. So you have the moving averages, and then once you get into a trend situation, it comes down, price move up, and that becomes a sell. Comes down, price move up, that becomes a sell, for example. Right? Okay. or some would say that, hey, look, I joined the trend line, as you can see, and then I put in the Fibonacci when price retraces near to the trend line, confluence with a 62% with a price reaction, a price action, they can go short. So there are a lot of methods. Okay, so the one method that I like to introduce to you is what I call a divergence indication, meaning a divergence trading method, and with the trend or against the trend divergence method. All right, so let's take a look at this particular chart here. All right, so priced on a 60-minute. Okay, so this is a 60-minute. All right, meaning that one bar is actually equal to an hour, so that's a 60-minute chart. All right, so price has been moving down, 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 down. All right, so and then in this downward movement, we can see a slow move up. Okay, now when price starts to move up, it is still considered a downtrend, because if you take a look at the whole setup here, it is still a lower high as versus previous high. If we are to break down this price movement here, you realize that as price goes higher, when I put in an indicator which is called the MACD, or any indicator, for example, a stochastic or RSI or CCI, whatever you want to use it, you realize that as price goes higher, the indicator, the MACD histogram, did not agree. Okay, it means that the bulls here, all right, the bulls who are pushing price higher, they are quite weak. Okay, so therefore you can use this chance to short, to enter the short. All right, so how does the divergence concept work? If you have a bullish divergence, right, you have to compare price with the indicator. So the indicator, as I explained, can be any indicator that's your favorite. Okay, so I prefer to use the MACD or the stochastic. All right, so as price moved lower, right, so for example, as price create a new low versus a previous low, the indicator did not agree. Okay, so the indicator did not create a new low. Instead, the indicator make a higher low. You can see that as you compare the two lows here, the indicator actually make a higher low. Okay, so price hit lower, indicator did not. That's considered a bullish divergence, meaning that you will be expecting price to stop heading down, potentially to move up. Okay, now the other way is where price did not make a new low. In fact, price was supported and you make the same low here. All right, so you look down, compare your indicator, you realize that your indicator also never make a new low, never make a same low, but instead make a higher low. Okay, you can see higher low here for your indicator. So this is also a sign of a bullish divergence, okay, implying that potentially in the future price might be heading to go up. Okay, so if you take a look at the bearish divergence, then what did I do, right? Bearish divergence, I shorted on the bearish divergence. Price hits higher, price goes higher. As price made a new high, okay, the indicator is showing you that price, or whoever who pushed price to become a new high, is actually a little bit tired, because instead of making a new high for the indicator, is actually slant downward to show a lower high. So you see this picture here, it's the same as what I shorted. For example, earlier when price made a new high, the MACD histogram, the one that's in vertical bar, actually going lower. Okay, so I'm actually shorting in the same basis. All right, or when price going in the same high, moving on the same high. All right, your indicator is not on the same high, but instead it's actually going lower. Okay, going lower here. All right, so this would be sign of a bearish divergence and sign of a bullish divergence. You can use that, especially when it's with the trend. It's very useful. Or for example, when you have a bearish divergence, make sure that price is near to a resistance. Okay, that's a very, very effective way for trading. Or when you're looking for a bullish divergence, make sure that price, that means price low here, they are near to a support. Okay, all right, now, so the last way of trading is what we call volatility trading. All right, volatility trading, such as there's a price surge. Okay, price actually surge upwards. Okay, you put in a Bollinger Band. Right, so this Bollinger Band is to indicate whether price is at a strong resistance at the top of the band or at the bottom of the band. So if it's at the top of the band, all right, and price rejected the top of the band to head back down, then this becomes a price rejection. It means that you know, it's an artificial push up, and is although that is very bullish, but the bullishness cannot hold. Okay, and then it closed back down. So what I did here is to put Bollinger Band. When price at the top of the band, it cannot stay above the opening bar. Remember, I talked about the opening bar as a very, very important clue. When it cannot stay at the opening bar and it closed below, all right, with an overbought RSI, that becomes a chance, a clue for me to actually go short. Okay, so that's just a very quick, simple introduction. All right, now what I'd like to do here is that I realize that you want to see some live trading, because but sometimes when it's during the lesson time or the webinar time, all right, we can't show that because then it just doesn't come off. Okay, so what I did is that during my live trading, my own trading, I recorded my trades. Okay, and I recorded over a period of time to show you how I manage, how I feel, and etc. Okay, so what I'm going to do is I'm going to show you the first trade that I did on the 21st of October. That's a very simple trade, but more important, later on I'll be showing you the 2nd and 3rd of November, how I managed this trade. Okay, so I've recorded that, but I will be narrating because you can't hear what is being said. Okay, so let me just show you that. Okay, so this one here. All right. Okay, I just want to make sure that I gotten the thing correct. Okay, so what happened is that this is a trade that I did, right? So if you can see, the time was about 4+ already, right? And I'm using a 60-minute future chart. Okay, I always prefer a 60-minute chart here, right? You can see that when I drew this trend line, there was a point here and there's another point here, right? So there's 2 points, and I use the top 2 points to predict this point. And price hasn't really been breaking above. We can see a lot of long tails here, but more important, there's this stochastic that shows a bearish divergence. You can see that price was heading up, but the stochastic was actually going down. Okay, you can see that stochastic was heading down. So what I did is that I shorted based on the opening bar concept. For example, price has been hovering, and then there was this red color candle here. Okay, so at the end of the red color candle, when price closed below the previous low around here, that's where I shorted at the close of that bar. What is the meaning of at the close of the bar? For example, the time now was about 4+. I shorted about 4 o'clock, and then it actually moved quite nicely downwards. Okay, you can see that at this moment here, there was this how to say support here, right? Okay, so my question to all of you, if I have shorted at a high price, then how do you calculate the profit? Okay, so I'm just going to switch over to my slide. Let me just get my slide for you. Okay, so give me a minute to get my slides. Okay, now you can answer me at the chat box, all right, so I can know your answer. The question would be that if I have shorted, okay, so you should see my slide right now. If I have shorted one SiMSCI contract based on what I did, all right, and I've shown you that if I've shorted one SiMSCI contract, then what would be the price based on the top here? What would be the price that I'll be shorting? Okay, is the price at the bid price or the ask price? You can just give me your answer at the chat box. Let me just look at your answer. If I want to sell, would I be selling at the bid price or the ask price? On top here. Okay, I'm just waiting for you guys to type the answer for me.
We have some answers in the question box already, Vinny.
Okay,
Quite a number.
so you will be actually selling at the bid price, right? Okay, so you'll be selling at the bid price, which is 292. So I shorted around 292. And if I were to say square my position, square means that to close my position to make a profit, then based on the quote at the bottom here, right? So what price would I be buying back? Okay, would I be buying back at the bid price or the ask price? Okay, I will be actually buying the position back at the ask price, always at the higher price. Okay, so if I were to short, I would be selling at this price here. Okay, if I were to square the position, I will always be buying back the position to close the position at the higher price, which is this price here. All right, so therefore in terms of the profit that I can make, okay, in terms of profit I can make, all right, the price point gain would be 292, okay, minus 290.5. So the gain would be 1.45. Okay, now as I explained before just now, recap, per point price movement on a one contract will be $100. Thus the estimated profit will be 1.45 times 100. That will give you 145. Okay, so how do you calculate your profit margin? Your margin will be calculated based on your profit divided by your margin. This is the estimation, and that will be 6.5% in terms of your estimated profit. Okay, so you know you can do it quickly in just potentially a few hours, or even sometimes if the price movement is good, you can do it in just like an hour and it's done. Okay, so that's the trade that I did just now. Okay, so what I'm going to do is that we're going to repeat the same thing, but to show you another trade. And the trade that I'd like to show you would be another trade that I did, which is the bullish trade on the 2nd and 3rd of November. Okay, and this bullish trade was very, very important because this was a huge win for myself, all right, and that was really to catch it at the bottom. Okay, remember the STI hit the 2,500, the cash index, right, hit the 2,500, and right now is actually non-stop all the way to high, right? So how do you catch this particular turn, okay, in the SiMSCI? All right, so let me just share the video. Okay, here you go. This would be the second trade that I did on the 2nd November. Okay, so SiMSCI has been dropping for a few days already, and right now it's actually showing a green bar, right? So I can show you the live trade which I did was the 2nd of November, 3:30. All right, we're gonna see how this is gonna close, but let's take a look at the 1 hour, because I always use the day as a gauge. All right, and I always trade that in the 1 hour. All right, so just to take note that stochastic is at the low. All right, we call this an oversold situation. All right, so right now I'm at the 60-minute already. All right, you can see just now the divergence trading that I show you. Right, we have this price moving to the same low. Okay, so it's about the same low here, but the stochastic is showing a bullish divergence. Okay, where is the bullish divergence? You can see the stochastic is actually going higher. Okay, all right, now what I've pointed right now is what we call the opening bar. Remember I talked about the first 30 minutes opening bar. All right, but the price at the next price here, the next bar is actually higher and trading higher than the opening bar, with a bullish divergence on a support. All right, and price moving higher and close higher than the first opening bar. All right, what I did is to buy, all right, the buy at the first opening bar. Okay, so this is the opening bar, and I drew in the price, and that's about 275. Okay, so the buy entry is around 276.3. All right. So what I like to do is that once I make the entry already, I always like to go to the higher time frame, which is to go back to the day chart to take a look at a possible support. Okay, so I've identified these as a possible support here. Right, this support right now, it's becoming a resistance. Okay, meaning that you have a previous support becoming a resistance right now. All right. Okay, so 1 day later, I went long already. 1 day later, you can see that price is actually moving very, very nicely. Okay, the price that I entered yesterday was around this bar here. Okay, all right, and you can see that on the day chart, price has been on the green side, so I'm into a profit. Okay, but I have to have this position overnight, and I'm also noting about the support level that is right now as a resistance. Okay, so what do you do? Because right now it comes to a very strong resistance already, right? A very, very strong level. What do you do here? All right, so you always can, what you do is that manage the position via your stop loss. Okay, so how to manage your stop loss? All right, you can see that price has been moving very nicely, and the time now is 3rd November, about a few minutes for the cash market to close. Okay, 11:52 a.m. Okay, again to recap, how was this entry being made? There was a bullish divergence. Price had a same low, and then the stochastic actually make a higher low. Okay, and I make the entry when price is to close above the first opening bar high. Okay, around 276.3. Okay, 276.3. The price right now is about 280.3. So you can see that it's about 4 points profit, and the original target was at 280.3. Okay, so question would be that if I have made the entry at 276.3 and the price is at 280, okay, so what's the profit? Okay, we can do a calculation later, but more important would be, I think a lot of people who are trading, they are wondering whether they should close their trade, okay, and take profit, because in a day you make like $300+ for a contract. Okay, that is really good. Okay, but the question is that if you want to make a lot of money, then you have to make sure that you can continue to ride on the winning trade, which a lot of people can't do that. Okay, so how to ride on a winning trade? The key is to shift your stop loss. Okay, shift your stop loss into what we call a break-even point, so that it will set your heart at ease and you don't have a fear. In a way, you don't have a fear. All right, so it's very much on the proper trade management. So what I did was that I saw that there was this low here, and I actually shifted the stop loss to 276.3, okay, which is my break-even price, right? So if price is to come down, all right, then this particular trade will result in a no loss trade, meaning that if price is to come down, you won't have any loss. Okay, so this is what we call to shift to break even. Okay, and if it comes down to that stop loss point, I'll be out of my trade with no loss, and that's a pity because I had like $300 to $400 in my pocket already. Okay, so what happened? I always like to make a decision just few minutes before market close, before cash market close. All right, remember I shifted the stop loss here, and when we talk about that, it was about 280, and right now it's about 7 minutes before the market close. I wanted to make a decision, okay, because cash market is very important for the SiMSCI trading. All right, so we bought into here. All right, shift the stop loss into this place is a break even, but right now price has gained another 2 more points. Okay, so if I bought at 276, it's at the 282. It's actually going higher. So the question would be, should you continue to let it ride, or should you take profit? Okay, so there is no way to answer that. You have to answer that for yourself, because for myself, what I always like to do is I always like to shift the stop loss. okay, because it's not easy to get a good trade. So I like to shift my stop loss and make sure that I get a lot of profit for this particular trade. And I always would fall back to the day chart, meaning that instead of just looking at a smaller time frame, I will fall back to the day chart. And I realized that the day chart will give me very good levels. So for example, I drew in another level here, and that level would be at the higher price, okay, and you can see that there's multiple of support, used to be support, and right now becoming a resistance, okay. So that's around 285. All right, so I'm prepared to hold my trade and see if I can continue to ride, and I have now shifted my stop loss to here, 280. So instead of 276, I've shifted my stop loss to 280. So if price is to come down, so I will be out at 280. 280 minus 276, I will still probably get about 3 point something points. Okay, so that's about $300 plus. It's still a good money. Okay, so very important, proper trade management by shifting stop loss. Okay. Okay. All right. So that's the trade. Let me just show you my slide. My question to all of you would be that if you were to be trading into this trade here, okay, like what I did, then if you were to buy, then where would you be buying? Okay, you will be buying at the bid or ask price. Okay, you'll be buying at the ask price. Okay, because when you want to buy, you always buy at the high, so you'll be buying at the ask price. Okay, so this will be the place that you're buying. When you are closing your position, okay, remember that I bought at 276.3. If you were to close a position to lock in a profit, and if you want to close your position, then which side will you be trading? Okay, will you be closing your position at the ask price or the bid price? Okay, remember, we are always worse off. So if you want to close that position, you will be closing at the bid price. Okay, so bid price here. All right, so in terms of the number of points gained would be 280.3, which would be the place that I close the position, minus 276.3, that would be 4 points. Okay, so to recap, 1 point would be $100, 4 points would be $400. All right, so just an overnight movement into SiMSCI, all right, then there will be a profit of $400 divided by your margin. Okay, margin, that's the amount of money that you need to start off this trade first. That's about 18.2%. Of course, at this trade, because I did the different way rather than to take profit, it was a very good momentum coming in, so I keep on shifting my stop loss, and eventually I actually closed the trade about 293.5. So that was a really a good one, about 17 points. So that's a huge profit in terms of SiMSCI trade, right? But even after I close it, it continued to move up. All right, you know, that's a pity, but then that's to me like a good trade being executed, and that's what I'm happy about. Okay, so I like to see that a trade is being properly executed. All right, and than to just scramble to get out of the position. Okay, all right, now let me just sum up what I've basically discussed here. Number one is that when you are trading the SiMSCI, it's very important, right, to have what we call a multiple time frame integration, because you need to look at the higher time frame to understand what are the important levels or what are the key directions. Okay, and by looking at the higher time frame, for myself, I would recommend day, okay, to look into the day chart for levels and for your planning. All right, and if you want to plan for lower time frame entry and exit, you can consider the 1 hour chart, which is a 60-minute chart, which is exactly what I've did just in my trade, right, which is to use the day to plan for levels and to use a 60-minute chart, right, for an entry and exit. Okay, and I use what I've shown you, which is the divergence. Okay, basically to find divergence, bullish or bearish divergence, and very important to have it confirmed with price. And I usually look for divergence at very strong levels, still on the day levels. All right. I'm one trader who likes to make sure I get maximum out of a trade. So I also like the peace of mind. So I like to shift a trade to break even. So when you shift a trade to break even, sometimes it's very frustrating because you start to see that a profitable trade and hit the break even, you get zero. So I can have $300, I can have $400, but when you shift that to break even and you realize I have zero, then I always ask myself, okay, why don't I get that $300 or $400? But the question is always, if I can know it earlier. Okay, so therefore, right, when I have a good trade coming, I always shift my stop loss. Okay, have a peace of mind. I can do whatever that I want. I can go exercise. I can go and watch a movie or whatever stuff. All right, and you have your profit or the loss protection. So very important. Good money management. All right, means that you need to start the position or the trade with a stop loss in mind. All right, a target profit in mind, and where do you shift a stop loss, and very important, a trade size. Okay, you know that when you trade the futures, because of the leverage, you can make a lot of money, but likewise you can actually lose a lot of money. Okay, so very important is to have that trade size evaluation, so that in any case when you start to see your losses coming in, okay, that losses because of your trade size will not be too scary. So for example, if you only make a funding of 2005, okay, and then you can only trade one contract, but it so happened that this particular trade entered into a loss of $1,000 over 2005. Okay, it's not possible because by $1,000 you get margin call already. But imagine if you have a $1,000 in terms of losses, okay, that's a lot out of 2005. Okay, however, if you can, let's say, make a funding of 10,000, okay, sufficient margin, you open a trade which is one contract, you make a loss of, let's say, 1,000. 1,000 over 10,000 is actually not that scary yet. Okay, although 1,000 is still a lot already. Okay, so this is what I mean by trade size evaluation. Okay, all right. Now what I did is I come to the end of the webinar. If you like to get a demo that we can scan and get a Philip Nova demo. If you'd like to know about the upcoming webinars, then you can scan to know about the webinars. And lastly, if you'd like to open an account, you can scan that. But I like to take some questions if you have. Okay, I'm not sure whether you have any questions. If you have any questions, do let me know, then I can answer them here. If you like to look at some of the live charts of SiMSCIs or the live trading of SiMSCI, I can show it to you. We can discuss about that if you are interested. Okay, so there will be a check function at the right hand side. I think at the right hand side of the panel or somewhere, and then you can type your questions so I can look at them and I can answer your question. Okay, do let me know whether you have any questions.
Hey, Rennie, looks like we have some questions for you.
Yeah, okay.
The first one is for divergence trading using MACD.
Yeah.
Can you use it for any time frame?
Okay, so let me just repeat the question. For the divergence trading for MACD, can you use it for any time frame? What I like to do is I like to go to the chart. All right, I like to show it to you in a chart, and I think that this will give you a clearer view. Okay, so let me show my chart first. Okay, now this would be the SiMSCI chart that you are seeing right now is 1 hour. All right, and then this is the day chart. So you can just switch, and then this is the day chart. All right, so let me just put in the MACD for you to see. I'm actually a trader that doesn't like to have many things on my chart. I don't really have a lot of things on my chart. Okay, so this is the MACD. All right, so if you can apply the MACD, the divergence, on any time frame. Okay, just remember that the higher the time frame that you apply on, all right, the more significant the price movement will be. Okay, for example, if you apply a divergence trading on the let's say 1 day time frame, you can expect, for example, a movement of 5 points, 10 points, or 20 points. But if you apply the divergence on a 5 minutes, for example, okay, 5 minutes, right, you probably would not be expecting a lot of movement for this, because the 5-minute range can be just like maybe half a point or 1 point, for example. Okay, so let me just quickly show it to you. All right, if you take a look at this place here, so for example, price hits lower, and see that, okay, price is heading lower here. Now look downwards, okay, look downwards, all right, and then look this downwards here. You can start to see that we have a bit of a divergence coming in. Sorry, let me just, okay, you have a bit of a divergence coming in at this place here. Okay, can see that? So this would be lower and then this would be higher. So this would be the divergence coming in. Okay, so in terms of movement range, you probably will be entering somewhere around here, and you might be only having a a movement until the top here. So you might trade at 315, for example, to long at 315 or 315.1, for example. And you're going to hit into a resistance which is actually very near at 316. So you probably only have, let's say, 1 point. Okay, but if you apply the divergence in a higher time frame, that means a much higher time frame, then you can achieve more. All right, so for example, as price move lower here, so let me just draw for you. As price move lower here, okay, all right, this MACD and the histogram, can you see that they are all showing the bullish divergence, the MACD here, as well as the histogram here. Okay, now from somewhere around the entry 287, you can move to 295, for example, into a resistance. Okay, this will be a low, a high here. So you might have enter at 288 or 289. Your movement would be much higher towards like maybe 293, etc. So you get a lot more. So they can use in all time frame, but the higher the time frame, you get a lot more, and what we call a more accurate or less noise type of trade. So what I like to do is I always will be looking for a support in the day and to move to the H1 to look for divergence. You get cleaner, you get trades of less noise, and you have less wrong trades. I will put it this way. Okay, try to use it on the higher time frame. All right, so Sri, that's answered.
All right, Vinny. So we have another question which is slightly related. Why trade 60 minutes as opposed to 5 minutes? Is it because there's lesser noise?
All right. Yes, the answer is correct. You have to understand that the difference between multiple time frame. For example, okay, let's talk about this one here. This was exactly what I've shown you, right? In my entry. So in order for this green bar in a day to happen, all right, it needs to trade about 23 hours or 22 hours in the SiMSCI for this one green bar to happen. Okay, so if you are doing the 60-minute, okay, 1 hour, then you'll be doing basically 21 bars of this one here. Okay, so to make sure that you break key levels, what we call break key levels, for this bar to happen, a key level has been broken, such as that price close above the previous high here. So let me just draw for you. Close above the previous high here, for example, key level has happened. So when you are trading into the 1 hour time frame, you start to see that the key level has been broken more significantly. You get more confirmation. All right, so when you are trading in the 5 minutes time frame, you might be just trading in the first 1 hour, but it's only the second hour that it starts to break. So you only get a little bit out of the 5 minutes, right? So it depends really very much on objective. So for example, for myself, all right, I like to work less time, and I like to get more each time. Okay, so that's the reason why I wanted to use a 60-minute. It's regarded as slower, but it is one that can give you trades with less noise. Okay, You don't want a lot of noise, and you want to make sure that this particular trade give you a lot of money. And just to let you know, a lot of pro traders, they are on two extremes. One is that they are really on a tick basis. That means that they go 2 ticks, 3 ticks, they are out. Okay, and they are huge every time, 100, 200 contracts, all right, or 50 or 60 contracts. The other extreme, all right, is that they really take position. That means that they really take the range of each move, and they really go for higher time frame. All right, so I am more tilted towards the slightly the higher time frame. All right, so that's why I chose a 1 hour to sum up. Less noise, and very important, I want to do less work, and I want to get a lot more. Okay, Tan Sri.
Okay, so the next question is the SiMSCI, the Dow Jones, and S&P are all popular indices. What's the value proposition of the SiMSCI?
Well, one thing that I want to say about, right, is that it depends on your trading style. Number one, if you take a look at the margin, meaning the amount of margin that you need to put it in, right? Of course, that it's comparable, all right? But you know, if you take a look at the SiMSCI movement, when it's really moving very nice, can move very nice. Okay, so let's take a look. The Dow, yes, is moving, but it's not as clear. For example, this week, right, and last week, SiMSCI has been moving a very clear range. Okay, it's basically one direction. You just have to go long, and then that is the trick here. So every instrument, right, will have its own mood. So for example, if you are looking at, let's say earlier, you don't want to trade the SiMSCI, you want to trade the NASDAQ, okay, because NASDAQ is really moving in a very nice trend. Okay, so you don't want to reject the SiMSCI, neither do you not want to focus on the Dow. Basically, as if you want to make a profit, you go to one that can trade very nicely at this moment. Okay, so SiMSCI sometimes it doesn't move very well because there's no range. But when it starts to break out of a certain range and the themes come in, all right, then you realize that it's moved very well, and it just like a bug, energizer bunny. It just doesn't stop. Okay, like what we are doing right now. Okay, so for me, as I said earlier, I look for opportunity. This has a good opportunity, I go here. That has a good opportunity, a good range, a good trend, I will go there. Okay, so I don't reject SiMSCI, but when days which is not good, I don't trade it. Okay, so that's why I'm using the higher time frame. Second thing is that there will be one instrument, or there'll be few instruments that you are very familiar. They are just like your babies. You see them, you know the levels, and you know what you're looking for. Okay, so SiMSCI will be one such instrument. I see it, I know that this is a level that I can trade, and or this is not a level I want to trade. Okay, so I think that I'm answering this from a perspective of where the money is, right? If it's an easy trade, just go here. If it's not, and it's just range bound, it's not easy to trade, you just move the Dow, you just move the NASDAQ, you know, for example. So that's the value proposition here. Of course, that in terms of margin, it might be slightly higher than other instruments. Okay.
All right, so we don't have much time, so we're gonna have a quick fire round, Vinny, if you're ready. I'm
Yeah.
gonna launch the question at you, and you give us your quick opinions about it.
Yeah.
Okay, the first one is, can this trading method be utilized on the S&P or NASDAQ?
Yes, you can do so. It's the same as what I've said.
All right, so for to have a better gauge of whether the SiMSCI is on its current run up or it's going to continue or end, any indicators you recommend?
All right, levels. Okay, so for example, it's very important for the SiMSCI to break key levels. Okay, so let's just give you quickly how to do that. Okay, so if you were to see what happened to the SiMSCI, it has been supported here and resisted here, right? So this is the key resistance. For example, this is the key resistance. Okay, so you can easily just draw in your lines. For example, that's a resistant line. Let me just draw that for you. Here, this one here, and then you can have somewhere around here, right? Okay, so that's the 300. Okay, so for example, once key level has been broken, so first level broken, second level broken, they would consider the next level, which is somewhere around here. Okay, so that's the next level, right? Okay, so for example, you want to know that whether it's going to have a good move, then you'll be looking at the range. So the first level taken out, the second level taken out, definitely you'll be this level. So you're going to have the 300 to 310 level here. So that's a nice trade. If you can get just 80%, that will be a good money for you. Okay, likewise, this level broken. So the next level you want to consider would be this portion here. Okay, so you're going to have 315 to 320 or even 323. Okay, so that's another good level being broken. All right, so we look at levels, key level broken, and these key levels must come from the higher time frame. Okay, Sri?
All right. Our last question is, which do you think is a better fit for beginners in terms of trading? Would it be currencies or index futures? Tough one, I'm sure.
I think that I have to answer that from the psychology point of view, because I have many students, they ask me these questions. What I like to do is I like to manage the psychology as well. We saw a lot of newbies having a lot of beginners luck, and they can make a lot of money initially, but they got overbought. I mean, as in they got over the head, right? And then eventually they just lost everything. All right. So what I like to do is I like to consider longevity of your trading. So I would actually recommend, although this is a session on SiMSCI, I would actually recommend the currency. That means that you trade the currency first. Okay. The reason being that for currency, you can scale down. You can, do with Phillips, you can do the one micro contract or one mini contract, for example. One micro contract, if we move by, let's say, 1 pip, all right, then it would be 10 cents. Okay, 10 pip would be $1. 100 pip would be $10. Okay, so you gain your experience via this way. Your losses, your profit, unfortunately, would not be stunning, because every time you also make $1, $5, or $10, or even sometimes $20. Then that's equal to 1 meal already, or 1 cup of coffee. But you start to pick it up from the slow, and you gain a lot of experience, and you let you consider the longevity. So therefore, I'm actually thinking of having you stay in this game long enough, then you can pick up all the experience. We can talk about a lot of trades, right? We can do a lot of guidance, mentoring, and when you're ready, then you go for the big one, something like that. So I think you can try something that is a smaller in size. Okay, straight.
All right, Vinny. I believe in our previous webinars you mentioned that you have a course coming up. Do you have any updates on that, or do we still stay tuned?
Yes. Okay. So this course is IBF sponsored, funded. IBF. It's launched by SGX, and that means that you get the, how many percent? Is it 90%? I'm not sure. Okay. This one I'm really not sure. You get quite a good percentage of sponsor funding from IBF. Okay. So SGX right now is working with SGX secretariats to launch this course. It has been approved for funding by IBF. The documents submitted, the course material submitted, etc. They are doing the marketing, but I unfortunately is under the SGX domain. I don't have any update. I've given them everything already. I'm just waiting for a date, and then they will organize. Perhaps that if I have further information, then I will give it to STRI, or you can follow up with SGX, etc. The other course that I'm running right now, which is also with SGX, is to talk about Elliott waves, simplified Elliott wave, which is a corrective wave, and how to use divergence, how to use Elliott corrective waves, how to use Fibonacci, and how to use Fibonacci extension to predict target profit. I believe that you have not seen this course with SGX before, because it is a new launch, I think it's going to be done on the 27th of November. The cost is $35, okay, for 2 hours, $35. I think that is a very good cost, because I don't think that they ever done the elevate before the extension to take profit. Basically, we do an extension, we can just predict how high it can go. So all these numbers are all already predicted before you even enter the trade. Okay, Sri.
All right, thank you so much, Vinny.
Thanks a lot, Sri, and thanks a lot for joining. If you do have any questions, just let Sri know, and or myself, vinny.ong@terraces.com. You can ask Sri for the contact. I'd be happy to answer your questions. Okay, thanks a lot, and apologize for the earlier technical issue. Thanks a lot. Bye bye.
Once again, we apologize for the technical issues earlier. Thank you for being a wonderful audience, and thank you for all the questions. If you would like to learn more or sign up for a one-to-one coaching session, please indicate your interest in our survey form at the end of the webinar. And do look out for upcoming webinars, and we will share a recording of this webinar to you in our follow-up email tomorrow. So do look out for it. Have a good night, and all the best with your trading. Good night.